Hey, welcome back. This is Mr. Market. Thank you so much for joining me. We're now on to episode 30. So I'm trying something new with this episode. You'll notice that you don't see me and that I'm narrating everything in the background. I'm trying this because I've been extremely busy over the past month since I'm taking jujitsu classes and I signed up to get a new certification to become a tax expert called an enrolled agent, which would get me certified by the IRS to do taxes in all 50 states and just managing the ups and downs of the stock market. I noticed creating these videos, it can take about 4 hours from start to finish, and stitching together all the recordings and setting up green screens and getting all dressed up can really take up the majority of the time to produce these videos. So I figured I could cut all that by about 80% to produce more videos more frequently, and that you'd rather get the information than see my good looks and facial expressions. So that's what I'm focusing on in this episode. So let's get to the charts that are worth noting for this past week. So this past week was pretty rough. We had the Federal Reserve keep interest rates where they were expected to be. But what they changed was the expectation for what the interest rates are going to be by the end of next year. And the market was expecting the Fed to have cut rates by about 0.5% by the end of next year. But what happened was they said, no, we're going to keep interest rates higher for longer. And so while the market had expected about a 0.5 point cut, the Fed's expectations did not take that into consideration. So the market had to readjust by about a 0.5 percentage point. And what I've typically noticed is that for each quarter percentage point of the market's expectations, the market seems to move about 2% for each quarter point. So what we had was a drop in the market by about 4% from 450 to about 430 in the span of about a week and a half. And what we ended up with was an oversold market that pierced its bottom Bollinger Band. Now, as a reminder, this Bollinger Band that you can see on the upper and lower boundaries represents a 2 standard deviation move for the market. And so it pierced the 2 standard deviation mark to the downside, which sometimes is considered an oversold market, but also it could also be the beginning of a much larger move. And so we need to take a look at other indicators to confirm the overall picture that we see here. And that's what this next chart shows. As you can see, the volatility index has pierced its upper Bollinger Band, which also confirms some heightened fear. It doesn't always work, but it's a little bit of additional confirming evidence that could mark this as a potential short-term bottom. So for more additional confirmation, I have added the RSI indicator, which is another overbought, oversold indicator. And as you can see, it is now more oversold than it has been anytime in the past half year. Whenever the volatility index pierced its upper Bollinger Band, it never quite got to an oversold level until this past week. So this is the way I'm looking at it. I want to see more confirming evidence from various indicators before I try to step in and buy an oversold condition. Stepping back and looking at the big picture, you can see that the primary trend that began in October is still intact, but the ones that started in March and in May, those have broken sharply to the downside. So the market is definitely weakening. It looks like support is a lot stronger at the 420 breakout point, and that is where I am setting my puts to sell for this week. I am at the 420 level, 416 level, and the 415 level. So I'm getting a little bit larger. I'm now leveraged about 3 to 1. As long as it doesn't fall below $420 this week, we stand to make a pretty nice recovery from last week's losses. And since we just had the Fed this past week, I thought it was interesting to take a look at this chart that shows how the market has behaved on the prior 8 meetings for the Federal Reserve. It's interesting how the market will jump up first and then sell off by the end of the day. And that's pretty much what we had happen this past week as well. So increasingly, the Fed days have been pretty dangerous days. And going forward, it's probably just going to make me more cautious because the surprise always seems to be coming to the downside lately. And because we never have enough things to go worry about, well, for this coming week, we have the potential showdown, with Congress not being able to come up with a continuing resolution to keep the government funded. So if that happens, then we could potentially have another government shutdown. And historically, if you take a look at this chart here, the returns for the market, it can vary. It can go from as much as positive 2% within the first week to as far as negative 4%, with the bias being more tilted to the downside. It looks like on average the markets will tend to fall. And so after this week, heading into October, I will take this into consideration and set my strike prices lower in case we get a market surprise to the downside. Okay, looking at our performance, we are still beating the market this year. We're up 15.88%, while the market is up 13.81%. Usually we fall down quite a bit less than the market. This week was pretty much the same, but we did fall a little bit more than usual because I did not set my strike prices low enough in anticipation of the surprise that came from the Federal Reserve. Interestingly, the algo did give me a sharply negative reading at the beginning of this week, but I did not lower my strike prices in response to it because I thought that the Federal Reserve's actions to hold steady was already priced into the market. The part that I didn't consider was how at the tail end of the future forecasts, they were going to keep it higher than expected. And so when the market crumbled, at least what I did was once my strike prices got hit, I did roll down to a lower strike price. I lowered from 439 and 438 all the way down to 435. And then as it kept going below 435, I rolled it down to 432. And so that helped mitigate some of the losses. Even though I was leveraged to the downside, I was still able to go fall less than the market. So that's an important part of playing defense. And, I like to say, in order for you to be a good winner, you need to be a good loser. And it's very hard to recognize your losses, but it's something that is keeping me in the game and it's keeping my losses contained. And that's an important part of being a good trader. Over time, playing a game of defense and sizing your bets accordingly, where you get a little bit larger as the markets rise and get a little bit smaller as the markets fall, has been a very successful strategy. We are up 34.55% since we started the pendulum algo in July of 2022, while the market was up only 16.39%. So we are currently returning more than 2 times the market with significantly lower risk using this strategy where we are selling puts and calls on the market and basically using time in our favor. We are monetizing the passage of time and we are adapting our risk sizes in accordance with the trends in the market. If the trend is stronger, we increase our bets. If the trends are weaker, we reduce our bets and sell calls to help hedge our risks to the downside. That's the basic formula for what we're doing. The magic formula here is coming with the sizing mechanism for the pendulum algo. And that's what's helped me significantly by introducing a process that keeps me disciplined and keeps my emotions a little bit more in check. And having a process is what's going to be key to improving your trading results. So that's all I've got for today. Thank you so much for joining me on this experimental video. I'll try to put out some more videos now that I can put these out with a lot less time. And remember to click like and subscribe, and then you can see more of my updates on a more frequent basis. All right, until then, I will see you next time.